it is where the pre-opening indicated a 0.25% higher for the Sensex.
We've got a gain of about 60 points up on the Nifty as we speak.
We were down to being up just about 30 points, and now we're up about 70 as we speak.
The market's been very volatile, largely in the green, but volatile. It was this brilliant last hour flourish, almost playing as per script, and it was led by the bank Nifty.
Markets remain ranged but see a last hour surge ahead of the US FOMC statement. Nifty and Sensex said nearly 1% higher.
Hero MotoCorp sees profit taking despite an inline set of fourth quarter results. Management says they've taken several cost-cutting measures. Also say they cut capex by half to improve operational performance.
Last hour surge sees Nifty Bank end 2% higher. Underperforming PSU and private bank stocks see the most gains. Some NBFCs do well after JM Financial's share raising announcement.
Biscuit maker Parle says they saw enhanced demand for all their biscuits, including premium ones, through the lockdown. While Titan says gold demand may subside due to smaller weddings, but company expects normal demand by the fourth quarter.
And Bharti Infratel's board will meet tomorrow to close its merger with Indus Towers. Vodafone Idea, which will get a stake in the merged entity, soars on the back of the news. Well, those were the top 5 headlines from Dalal Street on a day when the market surprised with an unusual and very sharp last hour surge. Welcome to Markets Today, the show where we will tell you all that happened in those 6 hours of trading in 5 headlines. I'm Latha Venkatesh, with me my colleague Prasant Nair. Hi, Prasant.
Latha, hi. I mean, absolutely stunning amount of volatility through the course of the day, up and down, many times over, and finally ending about 90 points higher. And this going into that important Fed meeting where, I mean, it'll be very, very important to see not just the decision, but the commentary as well. We've seen a string of positive data surprises from the US economy. Will the Fed take note of it? How will it react? Will it continue with everything in terms of accommodation? All of that. It's a packed show. We will bring you all of that and get you the opinion. Shiv Puri of TVF Capital Advisors. You'll hear from him as far as markets go. Nilesh Shah of Envision Capital is the other voice on the show in terms of markets, and corporate voices S. Subramaniam, Chief Financial Officer at Titan, and Mayank Shah, Senior Category Head at Parle Products, joins in with their commentary on the demand picture. From gold to biscuits, you get everything here over the next 30 minutes. As always, let's spend 2 minutes looking at the day itself. Latha.
Well, we started off with a bit of a profit-taking mode. Wall Street had sold off. Asian markets were mixed. Dow futures were choppy. And we too have put behind quite a few days of rally. And so there was a little bit of profit-taking. But it was always expected that the dips would be bought, and the markets played true to script. You can go back to several FOMC meetings. Markets go into the FOMC meeting with a surge, with long positions, because the Fed has so far rarely ever disappointed the bulls. Maybe that taper tantrum May 22nd, 2013 meeting or something like that, but not as a rule. As a rule, there is a Fed put in favor of the bulls, and that's what happened. The liquidity engendered rush has begun, and after all the top stocks have been hydrated, now liquidity is gushing into the underperformers. That was largely the story of the day. But speaking about underperformers, you have some data to support it, Prashant.
This is, I just want to start with 2 specific names, RBL and IndusInd. Okay, I'll get to RBL and IndusInd in just a bit, but I think what Latha, you're referring to is the market underperformance, right? I mean, let's just put those graphics up. This is just a very top-down, 30,000 feet way of looking at it, but it gives you the picture. Look at the markets, and this is data from as of yesterday's close, because, I mean, you'll have to put a hard stop at some point. This is as of yesterday's close. You can add that 1% to India today, but nothing very much will change. India is the most underperforming market, YTD. We've looked at these, comparisons from the lows of March. We've divided it into phases. We've looked at all of that. But US is down -1%. Developed markets have done better. Emerging markets have done poorly. But India is right at the bottom. I mean, those are basically 8 markets on your screen. I mean, actually, you could throw in a Brazil there. YTD Brazil would look worse off as compared to India, but that's the only one in terms of large liquid markets, right? But on your screen right now, in dollar terms, India is -22, and that's right there in terms of the very bottom of the rung. You could look at this and say, well, there is a lot more catch-up in terms of catch up in markets like India, which will happen. Or you could say, well, as Shiv Puri earlier was pointing out, that foreign investors are becoming more discerning, and they will now not just go with hope, but they will want proof before committing, loads of money in a market like India. Latha.
Oh, yes. Well, that's the point. When so much of liquidity comes in, it first goes to the high performers like the US markets, and then eventually it came to India. It seems to buttress that theory. Anything more in terms of stock-specific
very quickly, Latha, just taking through specific stocks. So it was all financials. I mean, PSU Bank, Private Bank, and the Bank Nifty were the three top gaining sectors. I mean, all banks. The broader gains were, mid-cap and small-cap part of the market also held up nicely. Advance decline was not, crushingly in favor of advances, but it was good. Nifty gains in IndusInd Bank, Hindalco, Axis Bank, Kotak Bank, RIL, SBI, ICICI, HDFC Limited. So you can see, huge amount of participation from financials. Losses, Hero, GAIL, and Coal India were the prominent ones. The broader gains in, RBL Bank, and RBL and IndusInd got mentioned together quite a bit. So big surges, especially in the last 30 minutes. Vodafone is back at 10 rupee 85, closer to 11 than 10. Indiabulls Housing, Granules India, PNB, Ujjivan, NBCC, Balrampur Chini, Dhampur. Some of the sugar names also participated, just highlighting, names with lots of volumes. And losses in the cinema exhibition names, PVR and Inox were down on pretty large volumes. Indigo, these are businesses which take direct hits basically because of the pandemic. Motherson and Godrej Consumer are some of the other names which continue to pull back. Latha.
Okay, but you can expect a major rally tomorrow going by what S&P has just said. S&P has reaffirmed the BBB minus rating and a stable outlook. That's extremely important because there was a big worry that S&P might put us in negative outlook. And these are fairly strong statements, could raise India's rating if the government significantly cuts fiscal gaps. So the big fear was that the current fiscal gap itself, which is more because tax returns are likely to fall this year. Already last year, instead of a 3.8 fiscal deficit number in the budget estimates, the reality has turned out to be 4.6%, 4.59 to be precise. But the stable outlook assumes a marked fall in the fiscal gap post FY21. So at the moment, I think India would be excused for the fiscal gap in FY21, but the stable outlook says that the rating agency is assuming that going forward, post FY21, next fiscal year, the fiscal gap will start to reduce. This has been actually S&P's observation. Their economist spoke to us some time back, and he also said that the expectation is that this year, everybody is going to have a negative, a contraction in GDP. Everybody will have a high fiscal deficit because tax collections are going to fall and expenses are going to mount on account of medical and other reasons. But if it is a one-off, it doesn't merit a rating change. And obviously, even the current reiteration of BBB minus and stable outlook says that the assumption is that from FY22, India will start correcting the fiscal gap. So I think India can breathe easy at least for 1 year. And maybe up until the next budget, we shouldn't worry whether S&P will revise, or maybe up until next June. This is a very big relief.
Yeah, but so this is positive for bond markets, definitely, in terms of bond deals, etc. But I wonder, because this kind of takes off, for example, equity investors like Shiv Puri were saying that there needs to be, stimulus, well-timed stimulus. This kind of takes the pressure away in that sense, right? If the government is saying that if the worry was rating would be more dependent on growth falling rather than fiscal, or the fiscal side of things, then S&P says, well, you maintain the fisc, the rating holds. Then, I'm just wondering what it means for equity markets.
Well, I'm not very sure the equity markets will not be happy about it. In fact, I think they would be relieved because the rating agencies are going to look through the current year's fiscal gap. So whether the fiscal gap is 10% or 12% or 14%, they may look through it. That seems to be the key takeaway from what the S&P rating reports is suggesting. Therefore, I'm not sure the equity markets will ignore it. One, because S&P is kind of primus inter pares. It is the more important rating agency. And there was a fear that there could be a rating, an outlook change, not a rating change, an outlook change. And this is going to be major relief. There are some equity investors who invest only in investment grade countries. There are also some companies which give FDI, especially if it's a new country which they have not ventured into. They would prefer it to be investment grade. So this is a very important information. Of course, it's more important for the currency. If the currency were trading now, you would see strength in the currency. But this is important news.
Okay, absolutely. So that is opinion coming in, and we'll try and sort of get in touch with the S&P ratings representative to get a word in on this. But let's get you some opinion that we promised right at the top of the show. This is Shiv Puri, Managing Director of TVF Capital Advisors, and Nilesh Shah of Envision Capital on their take on markets from here. Listen
in a market like India to expect V-shaped recoveries when you have a very complex, diverse economy is being way too optimistic. So as I see it, the markets will remain bifurcated like they have over the last many, many years. There are a few great companies that account for most of the gains. And in this environment, that's probably going to continue. There is a fair bit of under ownership and sort of near-term views on the pharma. Pharma is it's not as smooth sailing as it looked. Again, for the last 10 years, it's been a very difficult place to be. Even today, the FDA is being, quote unquote, more lenient than they've been in the past, but even that may not last. So I think pharma is something that certain pockets of it have a lot of potential, but for India to capitalize on it, the premise of which being it is the low cost provider, that is going to be tested.
We've clearly seen a liquidity-driven rally. You could call this pretty much a bounce back from very oversold levels. And obviously, in addition to that, there have been strong tailwinds of the global markets, particularly the U.S. markets. So you could see it could just be a combination of all these three factors. But we do have to keep in mind that the commentary that is coming out from the managements post the March quarter earnings is one of caution. I think most of them don't believe that a recovery is likely to kind of come before the second half of this financial year. That's actually what they are betting on. And therefore, I think investors need to, of course, be cautious at these kind of levels, given the kind of pullback that we have seen.
Okay, well, we move on to the second story. A sharp surge in the last hour saw the Nifty bank end close to 2% higher. However, it was the PSU bank index that gained the most. That rallied close to 4% in the green. Some NBFCs were also doing well after JM Financial announced a QIP. This is one more sector, Latha, which takes note as we come back tomorrow in response to the S&P saying what it has.
Oh, absolutely. The banks would be the most advantaged. As you pointed out, the bond markets would be cheered up.
Yeah.
And as the bond prices rise, banks which own all these bonds are going to see a mark-to-market gain. And in any case, just to reiterate the point we were making earlier, liquidity has been rushing to the underperformers. And who underperformed March to now? It's the PSU banks. It is the smaller mid-cap private sector banks. As you mentioned, RBL had underperformed, DCB underperformed, IndusInd underperformed. So we saw first money going to IndusInd, and now it's going to RBL, now it's going to DCB. You're seeing all these banks. And likewise today, IOB, those kinds of banks, UCO, the rank underperforming banks saw a lot of money coming in, and they were the highest performers. You want to add to that?
I just wanted to put up levels. In terms of RBL and IndusInd, Latha, simply because they're just doing a catch-up. So the Bank Nifty, the index, and RBL and IndusInd both are part of the Bank Nifty. The Bank Nifty is only about 4% away from its 38% retracement of the fall from the Feb high to the March low. Even after today's big rally in RBL and IndusInd, IndusInd is 22% away from its 38% retracement. RBL is 16% away. So, both these have been huge underperformers, and you saw that clearly. These were the big ones. These were bid up big time, and names like HDFC Bank, ICICI, etc. were in the positive, but nowhere close to the kind of gains that we saw with some of these banks in trade today. Yeah.
Okay, we will try and get you. India's labour markets have weakened dramatically. There are more observations coming from S&P, and we'll try and get economists and bond dealers to hold forth on this. India economy remains an outperformer versus peers in the long term. Now that's very big. See, this was one reason why India's fiscal gap was forgiven, because it's a growing economy. And I remember the CEA telling us that it doesn't matter even if our growth falls to even 4%, we will be able to maintain, pay back our debt. The whole reason why a higher fiscal gap is allowed for India is that because it grows faster than other countries, it can pay back. When would you be given a bigger loan by the bank? When your income, when your salary slip shows that you have been rising, you're getting a rising income, and therefore you'll be able to pay back the debt sooner or later. That is a big observation coming in from S&P, that India's high growth status is still not under threat.
See pressure on India's rating if growth doesn't pick up. I mean, I think those are, those are things which will also be taken note of. So right now, status quo for now, but I think some of those important points coming through from S&P, as you pointed out.
As you're absolutely right. They're pointing out that if the deficit exceeds their expectations and if growth disappoints, then obviously the rating will come under question. But it looks like the danger is over for now, even though these warnings are there.
Yeah, absolutely. We'll come back to this in just a bit. The third headline now, Hero MotoCorp falls 4% despite reporting an inline set of fourth quarter numbers. My colleague Sonia is here with quick takeaways. Sonia.
Well, thanks a lot for that. So, at the con call, there were some positive statements that the company made. One, they said that the retail market is seeing a pickup now. There is downtrading going on, so people are buying cheaper products, but they are well positioned to capture the change in preference. They also said that they had a one-time discount that they had to give dealers to get rid of the BS4 inventory. If you strip off that one-time cost, the EBITDA margins would have actually been 13.5%, so which is also a positive. They also mentioned that the manpower has returned to all of their plants, not at the full level though, but all their vendors have opened up now and the capacity ramp up will be gradual. 90% of their stores are now open and all their outlets are seeing a good retail pickup. They refuse to give any kind of guidance on what demand will look like. They said they need to watch for about 2 to 3 months before taking that call. But definitely the retail market is seeing a pickup, which is the key positive. On the stock itself, there's some profit taking after the huge run-up that the stock has seen over the last.
Sonia, actually, we already updated about the stock. We'll come back to you because there is the breaking news from S&P that they have retained the BBB minus rating and the stable outlook. The big fear in the market was that the outlook could go into negative. Joining us now is Anant Narayan, former bond trader, bond expert, and now professor of finance at SP Jain Institute. Anant, wouldn't this be a big relief for the bond market?
Definitely a big relief, Latha. And particularly maintaining a stable rating indicates that they're not going to act in a hurry. S&P, to be honest, amongst the three was always making the most positive of noises. So to that extent, it's not entirely unexpected. But yes, it is a big relief, particularly after Moody's had downgraded us and kept us at a negative watch. I think the one to watch now will be Fitch, who haven't been making very pleasant noises. As long as Fitch comes out and keeps us on stable rating as well, I think then we are safe. In general, Latha, I think it's fair to assume that given that all three big rating agencies now have us at the minimum investment grade, they'll be very, very careful about pushing us over the border, over the limit. No rating agency will want to do this very lightly. I think they'll give us a long rope.
Okay. There are three statements from Fitch, from S&P. Anant, if you can react to that. One, they say that the rating is under threat if the fiscal deficit exceeds our expectations. Now, I don't know what they have factored in. It also says that they expect the fiscal gap to start reducing from FY21, which gives the impression that we are excused for the current year. And third, the rating is under threat if growth does not return after FY21. So do you think that FY21 we breathe easy even if fiscal deficit goes to whatever, 15%?
I think so, Latha. I think so. They can't be blind to what's happening. The writing is on the wall. The borrowing program for the government has been increased. Even state governments have been given more room to borrow. So it's quite obvious that we will see a large fiscal slippage. Even the governor of RBI has said that, you know what, we will see negative growth this particular year. So I think they are going to give us a long rope at this point in time. Of course, I think the meter will start ticking from the next year onwards. And I guess they will want to see some consolidation in fiscal deficit as well as a return to growth from the next year onwards. But I think, yes, you're right. For this year, for FY21, as far as S&P is concerned, it's a long rope. I guess we're not the only country. Every country is going through this kind of a problem. So they will give all of us a long rope, I guess, in this particular case.
Now, since you raised the issue of Fitch, Anant, two rating agencies have said that, we are on negative outlook as far as Moody's is concerned, but BBB minus. But at least the rating is over and done with, so we shouldn't expect Moody's to say anything. Since two rating agencies are out of the way, you think tomorrow the markets can be off to the races, at least the bonds and the currency?
They're both bond and currency are going on their own team, Latha. Especially in currency markets, we are seeing a lot of inflows coming in. With all this Reliance Jio deals being announced, it does look like FDI will be pretty strong this year. As it is, our current account has probably turned into a surplus for this quarter. Even for the whole year, it's looking reasonably comfortable. So from a pure flow perspective, the currency market is quite comfortable. In fact, RBI is mopping up the dollars at this point in time. So I don't think the currency markets will be too particularly worried. Bond markets also, frankly, the comfort comes from the fact that there is RBI, there is monetary policy, which is very accommodative. So I don't think that is going to be a big impact as well. But yes, in terms of relief, it's going to be big. Fitch, if they come in and put us on stable watch as well, or stable outlook as well, I think that will be a big relief. And then, we can take it for granted that for the next 1 year at least, we have a get out of jail free card, and the meter will probably start ticking after that.
That's why I wanted your reaction for one more thing. My sense is, of course, there would be some peer pressure on Fitch as well. And maybe their angry previous or their rather harsh previous press release will be toned down. But, look at the words from S&P. See strong recovery from India post deep contraction in FY21. See India GDP growth at 8.5% in FY22. So till FY22, we are safe, you would think.
Well, some of it is a base effect, Latha. Sure. If we are going to see a sharp contraction in FY21, it is fair to assume that we will see a pullback purely statistically in FY22. I think these projections are going to change. We don't even know how this year is going to pan out. We are still struggling with things like, GDP data and inflation data for the current quarters. So clearly things will change going along. I think the broad message from S&P is, we know you're going through the throes of a COVID-19 crisis. We aren't going to be silly and put you on under a barrel at this point in time. We know you need time to negotiate this crisis. But I guess the meter for actually watching as to how we are performing will start once the pandemic is behind us into the next year. And at that point of time, I think we will have to evidence reform, return to jobs and output, and growth to give comfort to all rating agencies and to all investors that India can still recover from this and emerge stronger.
All right, Anant, we'll leave it at that. Pleasure speaking with you. Thank you for joining us. While we wrap up on markets, the markets anyway ended with a last-minute surge as if they were smelling that S&P is coming.
I was just almost wondering, because the kind of up move that we saw and then this coming,
we also saw a surge in bonds, the yields have fallen to below 6 to 5.98 on the old 10-year. Yeah. So maybe the market smelt that good news is around the corner. So it's not just the Fed. The S&P has also given very good news. And you must be prepared for a step up in the markets tomorrow.
Absolutely. Well, it's a wrap on this edition of Markets Today from both Latha and me. Thank you very much for watching. More coming up in just a bit.